Welcome, everyone, and thank you for joining today's webinar. I'm Sheila Olin, President of the CFA Society Switzerland. ESG investing is gaining increasing importance in the investment community. CFA has several initiatives to help this financial industry to incorporate ESG factors into the investment process. Today's webinar features some of the investment professionals who are part of our ESG committee. They will be discussing greenwashing or greenwishing. Can standardization help navigate the ESG jungle? During the presentation, please use the Q&A symbol to ask questions. After the presentation, these questions will be discussed. Our moderator today is Dimitri Senik, CFA, who leads the Investor Trust Services at PwC Switzerland. He has been a long-standing volunteer with the CFA Institute and is the chair of the GIPS Technical Committee and also chairs the newly formed ESG Verification Subcommittee. Welcome, Dimitri.
So welcome everyone on my side as well. And today I have the honor to moderate a great panel of experienced professionals who are all members of the ESG Committee of CFA Society Switzerland and who represent both investment managers and institutional investors. So on the panel today we have Michael Hähne, who is a member of the investment team of the City of Zurich Pension Fund, which is one of the largest pension funds in Switzerland, where among other responsibilities, he also looks after the pension fund's sustainability and climate strategy. We also have Aurélie Madé, who works at Partners Group, which is a leading private market investment management firm. She works as a senior portfolio manager in the private debt team. Aurélie is an experienced professional with a long track record in the area of impact investing and private markets. And we also have Stefan Skanes, who is a partner and member of the executive board of PPC Metrics, which is a leading Swiss consulting firm that provides investment consulting and controlling services to institutional and private investors. Stefan is dealing a lot with ESG investment issues, as well as sustainable investing is becoming more and more important for investors. And needless to say is that all panelists are CFA charter holders. So before we start with our discussion, I would like to set the stage by a brief introduction of the topic of today's webinar. I'm sure you all will agree with me that today there is truly a jungle of ESG investment approaches and products, and it's not always easy to find a true ESG investment product and to steer clear of investments that just pretend to be ESG. That's what we call greenwashing, or investment products that believe to be ESG but fail to achieve the intended impact. That's what we call greenwishing. And in the meantime, there is a clear consensus in the industry that there is a need for standardization in the ESG investing area. And this is demonstrated by various ESG related organizations and frameworks that already exist. And you see all those abbreviations on this page. Such as Sustainability Accounting Standards Board, Climate Disclosure Standards Board, etc. And all those organizations attempt to set a standard in various areas, for example, for issuer disclosures at the company level or for investment approaches. But the recently issued EU Sustainable Finance Disclosure Regulation, or SFDR, is also targeting disclosures at the investment product level. In spite of that proliferation of standardization initiatives, we still do not have a uniform framework that would provide clear and globally accepted definitions of ESG investment products and relevant disclosures. And this is where CFA Institute has taken the initiative and issued a consultation paper on the potential ESG disclosure standards for investment products. And the purpose of those standards is to become a global disclosure framework to provide transparency and comparability at the product level to investors and to help investment professionals fulfill their ethical duty to make certain information available to investors. So CFA Institute has received an overwhelming support from public comments for these standards. There were over 100 letters and over 3,000 comments received. And respondents were overwhelmingly supportive that a standard is needed to help investors better understand and compare investment products with ESG-related features. and that a disclosure-based approach would be much more helpful than a prescriptive-based approach. So the ESG committees of CFA Institute are currently working very hard to develop an exposure draft of the new standards, and the plan is to publish it for public comment in May this year. So having said all this, the focus of our discussion today will be how the standardization in the ESG investment area can help investors take the right decisions and find the right investment products. So besides the questions we are going to ask ourselves, we will also have a couple of questions to the audience, as we are also keen to have your view on some of those issues. So let me start with the discussion, and the first question is really for everyone on the panel. So considering an overwhelming number of investment products that claim to have an ESG focus, how significant is really the problem of greenwashing and greenwishing? So maybe Stefan, you want to go first?
Thank you, Dimitri. I can mostly speak from a pension fund perspective, and from a pension fund perspective, I see that greenwashing is less of a problem. Greenwishing is much more of a problem, and let me tell you why. I mean, basically, and that's very special for ESG investing, we have basically three rationales for ESG investing. I think the first one is a very old one. If you value a company as a financial analyst, since the 70s, since the oil crisis, you are used to look at ESG issues. You cannot value a company without looking at ESG issues. So the first rationale is simply it's part of a thorough investment analysis. The second rationale for ESG investing, so why to have ESG in a portfolio, is maybe simple and active bet. You can bet on value stocks, you can bet on growth stocks, you can bet on interest rates going up or down, and you can bet on ESG stocks. You can have an active bet in the portfolio that, for example, the oil companies are going to be bankrupt in 20 years' times. So it's a valid active bet. And the third and the last rationale, that's for me a little bit the dangerous one, is I see that people in pension funds or on the street, asset owners, that they would like to use portfolios as a policy instrument to enforce something they would like to do. So, and this is really a new rationale that the investment portfolio is kind of a policy instrument to enforce, for example, a CO2 reduction. And given that we have these three completely different rationales to have ESG in the portfolio, I think it's tremendously important to cope with this greenwashing by having a standardization. And the standardization shall help to find a common communication ground. The asset managers and the asset owners have to find a common language to communicate for what are we using ESG for.
Excellent, thank you. Michael, you have anything to add from the asset owner perspective?
Well, I would agree with Stefan's view that greenwashing is less important than greenwishing, because greenwashing, it is largely subjective, while a product X might be greenwashing for one investor, it might be aligned with the concept, a particular concept of sustainability for another investor. The underlying issue refers to disclosure and transparency, which allows an investor to better understand what he will get at the end. Thus, the whole discussion of ESG standards is where it comes in. But if greenwashing goes undetected, it may lead to unintended consequences. That can be, for example, a misallocation of capital, which can be dangerous. And the expected outcome of the investor doesn't materialize because it maybe cannot, because the underlying causality structure doesn't work. So there won't be any impact. So I agree that greenwishing is actually a much bigger problem than greenwashing.
Thank you, Michael. And Aurélie, as an asset manager, what is your view on that?
I will respond because I think all your valid points are already said, but I would say as an impact asset manager, I think it's part of your is really important because greenwashing, I mean, is part as well of your investment strategies, what you want to achieve as well in good attention. So it's a combination of a certain risk return that you want to achieve, and as well a combination of the which as a value creation for all that you want to achieve. And if we don't have standard about this, obviously you will not have transparency of your investment product, and it will be misleading. And as well, I recognize that, Michael, you will be misleading of capital allocation to the wrong strategy. And this as well, I mean, if we want to talk about ESG and on the company wise, I mean, if we don't differentiate between greenwashing and greenwishing, it gives a wrong incentive for the people to go a step further and actually to move from greenwishing to this switch to achieve sustainability.
Thank you, Orly. So now we have the opinions of the panelists, and we would like now to also ask the audience what you think about this question. So the question is, I hope the technology works and you see it on your screens. Are you concerned about greenwashing and or greenwishing investment products? And the options you have: very much concerned about the both, somewhat concerned about the both, concerned mainly about greenwashing, concerned mainly about greenwishing, or rather not concerned at all. Looks like the majority is concerned, either somewhat or very much, about the both issues. Really, people who are not concerned at all, this is really a minority. So yeah, I think this pretty much supports what we have just said. So thank you for those opinions. This is very, very interesting. Well, let me take another question, and this question is for you, Michael. So as I have mentioned in my introduction, there are various ESG regulatory and self-regulatory frameworks in place already. So what should these standardization initiatives introduce to really help investors to navigate among the variety of ESG investment products and to compare them?
Thanks for this question. If we take a step back, ESG is actually just a tag, and it can be attached to different things. And along the investment chain, the concept of ESG can mean various things for different people. So standards are important to narrow down the possible room for interpretation. And this is essentially what the frameworks you mentioned aim to do. Now, Stefan referred to standards functioning like a language which allows communication, and I fully agree with that. Taking this into this metaphor into the game, the more unified a framework is, the lower the potential for miscommunication. This creates trust, which is a large element in the whole sustainability debate. But on the other hand, the more rigid a framework is, the less does it capture, and thus may be of limited use. So we should always come back to the underlying problem that standards try to solve, which is to add transparency to how sustainability issues are integrated into investment processes and how trade-offs are being evaluated in investment decisions.
Thank you, Michael. That's almost a very philosophical answer. And yes, on that, in this context, let me ask another question to the audience. And the question is in relation to those various standards and regulations. So do you think those various standards and regulations are helpful to address specific matters around ESG investing, or do they rather create confusion among investors? And you have three options here: helpful, confusing, or not sure. Okay, so here we have the results. I hope everyone can see it. So it looks like the majority thinks that this is rather confusing, and yeah, quite a few are also not sure about that. And I think this is a this is a good signal for the standard setters really to think about when they when we talk about proliferation of various standard frameworks. And yeah, I believe we're going to talk about standards, obviously, in the next questions as well, but this is clearly a point that standards need to be clear and they need to be up to the point. So the confusion seems to be an issue. So thank you very much for those answers. This is excellent, very interesting. Let us move on to the next question. And now let's talk more about technical aspects of ESG investing. And this question is for you, Aurélie. So can an ESG investment standard help unify and increase comparability of various ESG metrics, measuring the impact of ESG investing? Or maybe even introduce a minimum set of KPIs?
Thank you for the question, Dimitri. As we know, it's very difficult to define a certain standard, especially across asset and industry and internationally. That's why we've seen different regulation in different places of the world. I mean, from my experience, the industry have been evolving a lot, and which is really positive actually for the market. But we are lacking amortization. I think from my different experience, every stakeholder has been using their own methodology, which make it hard to compare and aggregate meaningful data. I mean, like in any decision-making process, no data is better than bad data, right? That's why it's really important to have an ESG investment standard that will provide good, reliable data for investors to make their investment decision. But I think for me, it's not as well about market player. Of course, this will be a very good guidance to implement ESG reporting, but it's as well a corporate burden that will be reduced because it will be kind of the same standard to report for all key stakeholders. I think we are talking about a journey to achieve ESG compliance and show transparency. And if we take every player in place, and I think the fact that it would be more guidance and to implement this reporting set and not like an obligation, like a regulation, will be able to achieve a better impact as well. Because at the end, this ESG standard and the ESG factor, it's like the results that we get out of it. And we really want to have a positive income for all of us. I mean, for investors that will get less risk and a better performance, but as well for the company to move forward in this direction.
Thank you, Aurélie. This is a great answer. So let's talk about another technical issue around ESG investing, and this is the ESG ratings. So do you think an ESG investment standard should attempt to address such issue as a low correlation of ESG ratings among different rating providers? And if yes, is it rather by means of disclosure or rather by means of standardization of the rating methodology? Stefan, you want to take this question first?
Maybe we have to start first. What are we talking about? What's the problem? The problem which you mentioned is that very often we see that the same company have different ESG ratings depending on the ESG rating provider. A very famous example was Volkswagen, for example, which had some very good ratings before the scandal actually, and for other ones it was the other way around. So the problem we face is that different ESG rating provider can come to very different conclusions. So that's the problem we are talking about. And it clearly would be nice if we all could agree on these ratings. It would make maybe our work, our daily work and the daily work for the asset managers much easier if we could rely, for example, on one data source. A very strange example, if we could get from the CFA Institute for each and every company exactly the same very good rating methodology, and we would all use these data. So this would handle the problem of these low correlations. But quite frankly, for me, this would be a very, very dangerous road to go to. And I make an example, which is quite an old one. I remember vividly after the year 2000, we as an investment controller looked into a lot of portfolios of quantitative managers, which had quite a bad performance after the tech bubble went bust after the year 2000. And we were interested why were particularly these quant managers heavily hit after the bubble. And we found out that a lot of the quant managers had Enron in the portfolio. And we asked them, why did you have Enron in the portfolio? So there was a company which went bankrupt after the year 2000, you might remember. And the quant manager told us, we are using a very sophisticated risk management tool. And this risk management tool helped us to keep the ex-ante tracking error down. So a lot of very different asset managers used the same risk management tool. That's a very famous one. I don't tell you the name to be fair, but they used a very famous risk management tool. And this risk management tool thought that Enron is a very good stock to bring the ex-ante tracking error down. And this stock landed in a lot of quant manager portfolios. And I had a deja vu effect 3 years ago when I went visiting ESG managers for a big client in Europe. So we got the sample portfolios of these ESG managers, and they were completely different managers. Some were fundamental, the other one were quantitative. And we found that there is one stock, which is Schneider Electric, and this Schneider Electric was in more or less all of the ESG portfolios. I don't know the company very well. I'm not an investment manager, and it's obviously a very good company. But the reason was basically that this Schneider Electric had a very good ESG rating. And all of the ESG managers were trying to have a high ESG rating in their portfolio, so they ended up with some of the same stocks in the portfolio. And this problem or this example clearly shows it's extremely difficult and extremely dangerous if the whole industry would work on the same databases and the same ratings. So I think the standardization which you're talking about should never be a standardization of the approaches. We need these competitions between the asset managers, between the ESG investment approach. We need a healthy competition, but we need a standardization on the communication. The problem is, at the moment, it's very difficult to find a common ground between the asset managers, what are they doing in the portfolio and for what reason, and the asset owners, the pension fund, the beneficiaries, what do they expect from the asset managers? So clearly, I think the standardization should help with communication, but it should never be that we all use the same data, have the same approaches, and at the end of the day, the same stocks in the portfolio.
Absolutely. Michael, do you have anything to add?
Well, maybe not much substantial to add, because these are really good points that Stefan has mentioned. And again, ESG is not something that is black and white. There are many ways, different ways of analyzing certain underlying issues. For example, water usage or accident rates. You can take different metrics and they may come to different results. But because data might be difficult to get, or because an underlying issue is only partially understood, it may even help to have a variety of interpretation, because this allows me to ask follow-up questions. So I'm not worried about low correlations between ESG ratings per se, although this research that has been done recently is very useful. And it can provoke to go deeper and understand the differences between the ratings, which hopefully gets us to a better understanding of all the issues at question. What I would ask is for higher transparency on the rating methodology and providing information that helps me understand the underlying structure of the causal relationships between ESG issues and company performance, investment return, and also real-world impact. I think that's sort of the process that needs to work, or at least does work on the asset owner side. We need to understand what we are doing, thus building our expectations, and then have a system of monitoring how it works. Because, as I said, ESG is kind of a fuzzy concept, and we never get down to isolate particular factors completely in order to have the full transparency on how it works, as there are too many interacting factors in this very, very complex world.
Thank you. So I take from your answers that low correlation of ESG ratings is not a bad thing per se. And we do not want everyone to apply the same methodology and to have the same tilts in the investment portfolios. And I think the challenge here is that what investment managers should think about, whether this is really appropriate to rely on a rating just from one provider, or maybe rather it would make more sense to take several views, maybe even to come up with a consensus-based rating, and obviously also apply your own professional judgment and your own investment management decision-making on the top of that. And communication is a key here, absolutely agree. So thank you. And you mentioned already performance and returns. So let's talk about that a little bit. So how can an ESG investment standard improve the investment performance and risk analysis of the ESG products? Here I'm talking about, for example, incorporating ESG risk impacts into the risk-adjusted return, or showing the contribution of ESG factors to the tracking error. Aurélie, you want to take this one first?
Yes, sure. I think one thing that is quite, for me, important, I mean, it's like when we realize that there is material ESG risks that have been identified and tracked accordingly, thanks to the standard, it will help the company to focus on the areas that create the most value and make tangible progress. So we kind of giving incentive for the company actually to bring some performance to the investor. And I think using this as ESG standard, I think it's because at the moment we don't have the data, the record. I think if we could integrate this in our portfolio optimization, it will change the done. I mean, it will always help to do like the benchmarking analysis. I think I will give like a small example. I mean, it was the beginning of my career, and I think I did a minimum correlation replication of Optique, and it was perhaps 4 days before the nuclear accident, right? And of course, my index lose 18% after 4 days, like the Nikkei actually. And it's like, it's something that my return, my normal optimization portfolio could not have taken into account. And I think more and more at this time, if we look at the investment decision and the optimization, how we allocate, we have to integrate the ESG risk in this case and the performance. It will be part of it, and I think it will be the best optimization. But for this, we need to have data that we will be able to compare and to use and to trust, actually. So for me, it's really important. But perhaps, Stefan, you want to add something?
Yeah, maybe I think first we should know it's from a pension fund perspective, not from an asset management perspective. From a pension fund perspective, we have to answer the question, what are we measuring and why? And what are we measuring? There is one very important, simple task. In the law, it is stated, basically it's BVV Article 51, it says a pension fund has to generate market returns. So we really have to generate market returns. On the other hand, we are not allowed to forgo returns. We are simply not allowed as a pension fund to forgo returns. And I can answer one question. One of the petitioners asked, how much of diversification and liquidity should we sacrifice to become 100% ESG green? This is one question which I found in the Q&A. And the answer is quite clear, 0. As a pension fund, we are not allowed to forgo diversification, liquidity, or returns. So that's the task, because it's part of the law. We have to generate market returns. And this implies 2 tasks. Given that we have to generate market returns, the first task is ex ante. Ex ante, we have to make sure that we know the impact on the tracking error, on the investment universe, on liquidity, on returns. So here the standards can help us estimate, will there be an impact? So that's the ex ante task. Ex post, if we are invested, we simply have to find out why we gained or lost money. So basically, we need a return attribution if we are hopefully ahead of the benchmark, but if we are below the benchmark, we have to say what is a value tilt, a growth tilt, was it a bad diversified portfolio, or was it an ESG impact? So ex post, it can help us to identify what were the return drivers. So I think coming top down, first of all, we have to generate market returns. Ex ante, we have to know the impact on the investment universe, and ex post, we have to know the return drivers. And standardization can help us tremendously to do these two tasks.
I absolutely concur with you, Stefan. So I myself, I sit on the investment committee of our pension fund. And actually just yesterday, we had a presentation of an asset manager for a potential ESG investment product. And I was glad to see that they came from that risk return perspective. So the whole ESG approach was kind of nicely broken down into the investment risk impact and investment return impact. So because this is absolutely important for the pension funds in Switzerland. And I also agree with you that the future investment reporting will have to include return and risk attribution that would clearly show to us the impact and contribution of the investment decisions from the ESG investment decisions. So that's definitely will be a just normal element of the reporting going forward. So as we started talking about pension funds, let's kind of expand on that discussion a little bit. So question to Michael and to Stefan also. So would an ESG investment standard help pension funds find this right balance between the moral obligation to engage in socially responsible investing or to consider climate risks versus the regulatory fiduciary duties towards beneficiaries of pension funds, which are, as you mentioned, is primarily generating market returns. So Michael, you want to take this one first?
Sure, thanks. A pension fund is a legal institution and not a human individual, and thus it does not obviously have a moral obligation, which is something very much societal and subjective. But what it does have is, as has been mentioned, is a fiduciary duty to act in the best interest of its beneficiaries. Now, sustainability or climate itself is not part of pension fund law in Switzerland, as we heard, but there are enough expert and legal opinions that say that it is the fiduciary duty to consider all the risks pension fund investments are exposed to, which includes both financial and non-financial risks such as sustainability or climate change or biodiversity. I think standards can help to integrate such kinds of risk into the investment process and support the disclosure, as well as adding a certain level of transparency. And as kind of language, they do frame the discourse so people can speak about the different things. Where I am a little bit more cautious refers to the previous question on reporting and aligning sustainability data with traditional financial data, which I think are still a different category. And it could be difficult to agree on matrices or measures with respect to be it land use or biodiversity or habitat loss, that everyone agrees and that they are supported by such good data that they can be applied globally and consistently. So I think it will remain a much more fuzzy category that only partially can be quantified, which raises some questions with respect to reporting. So there will likely still need to be a certain level of qualitative information attached to the data in order to avoid misunderstandings. And I'm not sure, or I'm curious to what extent standards can solve that problem of the different quality these two areas still have. And yet, we also had the same discussions with respect to financial statements maybe 60 or 50 years ago, and people came up with global accounting standards like US GAAP or IFRS, and at least we have some rules and some clear mechanisms how these concepts are to be applied. So there is an excellent role for standards, but one can always argue, is evaluation much more difficult than to try to understand an ecosystem that is interactive, much more complex with many, many feedback loops. I don't have an answer for that, but I think this is something that, at least on my side, I'm still prepared to wait maybe a little bit longer for a definite solution.
Thank you, Michael. Stefan, do you have anything to add?
I think that in one word, the problem of ESG is broadness. The topic is extremely broad. So I talked about the three rationales. So the why are we ESG investing? And three rationales could be, it's part of the normal analysis, as I mentioned. Secondly, it's an active bet. And last but not least, a little bit a difficult one, it's a policy instrument. So an investor has to talk first about the why are we doing it, three rationales, and find an answer for themselves. And given an investor decided on the why, for example, they decide that's an active bet and they want to have in the portfolio, then they still have to go a step further and decide on the how. So how are we doing it? And in between the how, we have an extreme broadness. We can start with engagement, for example. We can say we leave the portfolio completely untouched, but we do engagement. We would like to engage with the companies, have a dialogue with them. We could say, no, we would like to go the road of negative criteria or exclusion lists. We can screen the whole portfolio and we would like to exclude some companies, controversial weapons, coal companies, you name it. So you could go the road of negative criteria. You can choose the road of so-called positive criteria. You can say we are overweighting the very good sustainable companies. We have a best-in-class approach. You could go the road of impact investing. You could go the road for green investing. There is such a broadness on the how to do it. And given that we have to decide on the why and then the how, it's extremely difficult for board members which have different educational backgrounds, different understandings of how financial markets work. I think the aim of the standards must be to find a common language. ESG standards should not provide solutions. They shall provide a language that we are all talking about the same thing on the table. And here, if we could be able to have the same language as we have, for example, for performance, the GIP standards allowed to have the same language when we talk about performance. Everybody knows it's a time-weighted return. It's calculated in a very special way. We have the same language, and here I think the standards can really help a lot.
Aurélie?
No, I would just say, like on an asset management side, I mean, I've been mainly private debt and private equity. I mean, it's as well for us to understand well what is key for investor. I mean, of course, for all of this, it will never be one number, as you mentioned, Michael. It could be part of quantitative, but it will be always qualitative, and especially in private markets. That's why on-site due diligence is key, actually, to have this qualitative aspect. So you will always have the both. So it will be very hard to unify, especially between the different industry. You will not look at the same KPI or same way if you look at a healthcare company or if you look at the energy company. So it's really as well to have a common language and to be able to have a common understanding of what is important for investor and for the companies as well.
I fully agree with both of you, and I think an asset owner should always be very much conscious to what he believes and define his objectives and formulate investment beliefs, how these objectives can be reached. And that's sort of the largest responsibility that he has, and an asset manager and asset owner should not think that he can delegate the whole ESG chain to an asset manager or to another third party. I think that's a really key part, that boards need to discuss what they understand under the concept, or how they understand the concept of sustainability or ESG, apply their principles and discuss them out, because it is very difficult among even 5 people to find a common ground on what sustainability really means. So that needs to be kept down and formalized in a document, in order to always come back whenever any issue arises and start from this common ground, and then discuss a strategy that then will be implemented. And here then all the different tools and ratings and methodologies come into play. But that's sort of towards the end of the value chain and not at the beginning.
Before we move over to the questions from the audience, I just want to touch upon one matter that has been raised many times after a CFA Institute published the consultation paper on the potential disclosure standard. And that's really about the role of CFA Institute in the development of a global ESG standard in the context of regional regulatory development, such as the European Union's action plan. So the question is really about whether there is a duplication, or whether there is a redundancy of those standardization efforts in the context of the regulatory efforts in Europe. And maybe I can try to speak on that myself first, and then everyone can obviously jump in. My view is that a CFA Institute is a recognized global standard setter. And it brings both a huge experience in standard setting, for example, the Global Investment Performance Standards, the GIP standards, but also the necessary resources and capabilities. And the goal of that initiative is that the ESG disclosure standard can be used in all markets globally. And to achieve that, obviously, it must be compatible with local and regional regulations. There are sure to be some differences. However, important is that those differences are not conflicting with local regulations. And the CFA Institute regularly shares its research and recommendations with regulators. But the goal of the proposed standard is not really to influence regulations, but to provide this much needed guidance to investment professionals in those markets that do not have regulations yet. So maybe the other panelists, do you have any views on that issue?
Maybe just shortly, I think the Institute has an extremely important role. I would have hoped it would have been 5 years earlier. Just kidding. I mean, it would have been a tremendous help if the asset managers could agree on standard of communicating what they are doing. Not on standard, on having a standard what they do, but on a standard on communicating what they are doing in the ESG space. And hopefully, I mean, the regulators have the same problems which we now discussed, the broadness and the rationale and all those things. And if CFA would be a front runner, see, these are the standards. We can have the products in a bucket. These are the engagement products, the impact products, the products where it's an active bet or whatsoever. I think the regulators will jump in. They will be happy that they can rely on the CFA Institute as a self-regulator, so to speak. And then I really hope the asset managers and consultants as well simply save a lot of operational hassles, because we can all agree on the same standardization.
Thank you, Stefan. So now we have some time to take questions from the audience, and Sheila Holland has been monitoring the pipeline of the questions in the background. And yeah, Sheila, over to you. What kind of questions have we received?
Yeah, thank you for the most interesting discussion of some very key and important ESG issues by the panelists. And also thank to the participants for your questions. And what I'll do is favor the most popular. We'll be just democratic here. The most popular question is, what do the speakers think of the forthcoming EU eco label for financial products? And I think associated with that is also the EU taxonomy for trying to standardize disclosures and definitions. Any comments?
from my point of view, I frankly do not like labels because you get what you measure, to be very honest. And I mean, if we will have this labeling, everybody will exactly try to get the label. Quite frankly, I do not think that this really helps the cause a lot. But it's very naive for me to think that these labels will not come. Certainly the labels will come because the pressure is enormously on the regulators to bring these labels. So given that the labels will come, that's for sure, I hope that the CFA Institute can help that these labels are broad and that these labels are a measure of communication, what the asset managers are doing, and not a method of enforcing what they should do.
Very good point. Thank you. Also, especially early on, there were questions relating to how would you define greenwishing and greenwashing? And a more quantitative question is, to what extent do you think greenwishing and greenwashing is evident in the sustainable managed assets in Europe? And the reference was made to the Global Sustainable Investment Alliance that shows 49% are in fact greenwishing or greenwashing. So what, Dimitri, you started off with a kind of a definition of greenwishing, greenwashing. Could you just elaborate on that?
Well, I think this is not really absolutely evident because as an investor, when you start evaluating investment products and they claim to be ESG, you don't really know that. And again, speaking from a perspective of a Swiss pension fund, you should not expect that everyone on the board of the pension fund has the technical knowledge to immediately see through, you know, the technicalities of description of investment products. So I think the realization that this is probably not really the true ESG investment, it comes actually ex post, it comes afterwards when you really measure the return and the impact. And yeah, I think we don't really have a big problem with greenwashing. I can't rule out, obviously, that there are people who really do that, but I think the majority of issues really with the greenwishing, that people believe, yeah, that what they're trying to achieve is indeed ESG and green, but yeah, for various reasons. There are also a lot of technical reasons here as well. Also with the underlying data, as we have discussed, they just fail to achieve that. And here, when it then comes, you know, to greenwishing, we all wish to have this ESG impact, asset manager and the investor, but it's not there. So maybe Stefan, Michael, and Aurelie.
Maybe just to add, for me, a very simple example, which I very often tell the people is, I mean, if pension funds are selling the stocks of coal companies, what really happens is that the value of the stocks might go down. But simply, if pension funds sell these stocks, the stock simply changed hand. Not 1 gram of coal is not produced by that. So simply by selling stocks, we will have the problem that maybe the stock will go down in price, but if they still sell the coal on the market, then the company will make some gains and the dividend yield gets higher. So at the end of the day, somebody else on the world has a higher dividend yield. We are basically creating a new value premium. There might be a value premium for environmental sin stocks at the end of the day, but this is not a help of the environment. And this will be, for me, be an example of greenwishing. We really have to think through what are we doing, and is this really helping the environment or social or governance or whatsoever, or is this just a wish from us?
Let me ask a provocative question or raise an issue. In the early 90s, the concept of stakeholder value came up, and then in that context, many companies along the years introduced corporate sustainability departments. There were many academic studies who tried to prove and sometimes disprove or at least give some evidence on its impact. Many people applied it, many people believed in it, but if we really ask ourselves, did it really help the world, the planet as a whole on an absolute perspective? I'm not so sure. So I think the skepticism towards greenwashing is really justified. And we really have to be careful, because most discussions, they take place on a relative value. Let's be incrementally more efficient in one process. Let's do something incrementally in another process or product. But what really matters is the absolute level. We have one planet, we have one ecosystem, we all live in it, we all are embedded in that system. That includes the social sphere, all the animals, biodiversity, climate is a large part of it. And this is what we should have in mind when we talk about impact. And I think whatever we do, it always have feedback effects, and it can even have an adverse impact of a rebound effect where we try to do something more efficient, which justifies buying more of it or producing more of it, which again will harm the planet, does have a negative impact. And I think it's this kind of discussion that needs to be targeted when we speak about greenwishing. It's not about the relative improvements, it's about the absolute level that we're talking about.
That's interesting. There is sort of another person who's saying, isn't like many things, there is a spectrum of greenwashing. An entity that's on the far good end of greenwashing is better than the one at the other end, or at least they're further along. Would you say that there's value of just becoming more green oriented compared to just avoiding it altogether?
I would agree with that it's better to do something than not do anything if we don't fall into the trap of greenwashing and thinking that the problem is solved. Mm-hmm. But I think the problem is that there is simply not much time left in order to really initiate some change. Depending on which scientific study you take, we have another 35 or 50 years until problems could get really, really worse. Is that enough time for incremental change year by year, or just wait another 10 years and then think about incremental change? I don't think so. But is it better than nothing? Yes, even incremental change might help. And I think it's important, if I think about a large company that cannot change from one day to the other, it's important to spark sort of the fire within the individual departments, individual people, which then can bring change along the way. And I think at the end, a completely different process can result if it's broad-based, if people start incrementally, but they have to move on. They simply cannot stop, and we cannot rest and say, okay, we have done a good job last year, so let's stop for now and see what happens. We need to move on. And I think the same is with respect to ESG in investment management. It's good to start somewhere, it's important, but we need to move on. We always need to check for better methodologies, better data, better processes in order to make better decisions that ultimately can support a much greener planetary system.
Thank you, an excellent answer. Just to move on, another question is, one person asked, who will pay for ESG? Who is going to be the ultimate bearer of ESG costs?
Maybe I can take that as well. Okay. Nobody asks the other way around. Who pays if you don't do anything?
We all pay. Society at large pays, I think. Here's a question for us in the CFA. What asset classes will be covered by the CFA ESG investment standards?
Well, maybe I can take this one. So it's actually about all asset classes. Because the purpose of the standard is not really to provide prescriptive definitions of ESG approaches or techniques specific to asset class. It's really about the disclosure. It means if you manage a product and it has an ESG feature, then you just need to disclose that. And yeah, so the upcoming standard, again, this is still obviously in the process of being developed, but it's not really limited to any asset class.
Good, thank you. Unfortunately, we're running out of time a little bit. What I would like to please ask our participants to check the chat function, and you'll see a link to the survey. We're very interested in what your opinions are. We want to provide subsequent webinars that might be of interest, so please do complete the survey that you can link to from the chat function. What I'd like to do now is just thank our panelists and moderator. There's been a really interesting discussion covering a broad range of important topics. We also appreciate all the attendance of all our participants. And please, we appreciate even more if the participants complete the survey. So thanks again. For those interested in pursuing further ESG investing expertise, there is a CFA certificate in ESG investing. For more information, check the CFA Society Switzerland website under study and exams. And in the meantime, many thanks again to everyone. Most interesting discussion, and best wishes to everyone for a wonderful weekend.